Stock market has been all over the place over the past couple of weeks, and that raises a lot of questions, and we've got the guy that's got the answers. It's Chris Hopkins from Barnett and Company. Chris, welcome back.
Chip, good morning. I'll try not to take it personally. You had me on Fat Tuesday for what it's worth.
The market really jumpy over
Yep.
the past couple of weeks.
Right.
I mean, record high and then losing, what was it, 4% alone in just one day.
Right.
What do investors need to do?
Well, the first thing is to put it in perspective. So the headline that day was Dow crashes or Dow plunges, largest single point drop ever in history, right? Pretty scary. It was the 100th largest drop in percentage terms.
Really?
99 times it has dropped more than that in one day as a percent of the market. So you started with $1, you ended up with 95 cents, right? So perspective is really important.
Does this come, I mean, we've had a year of growth in the stock market. Does the fact that we've seen it be so good for so long add a little bit of insult to that injury?
Well, there's no question that we've kind of been accustomed to long periods of time with pretty much one direction. And you mentioned the word volatility, which we means up and down.
Right.
We've had all up and hardly any down. So we have to go back and remember this is very normal. Trees don't grow to the sky is one of the adages, that the market will go up, it will come back and correct. And the fact is it had gone a little too far, a little too fast. Valuations were a little high. This is very normal and quite healthy, actually.
And I mean, I think sometimes when we have a lot of consistency with the market staying high, we tend to get comfortable.
Right.
So are we going to continue to see that trend of continued growth and remain higher than normal? Or are we going to see more volatility now than we've seen over the past few months?
That's a great question. And of course, if we knew the answer to that, in advance, we'd be in good shape. But my opinion is that yes, generally speaking, over the long term, the stock market is a measure of the general economy. Now, that's not true on a day-to-day basis. It's not true in the short run, but as long as economic fundamentals are pointed in the right direction, the economy is growing at about a 2.5% or 3% clip. That's great. Profits are improving. There'll be some kick in from the corporate tax cuts that were recently passed. So the long-term trend is still up, in my opinion, but expect these short-term pullbacks.
One natural reaction for many of us, get off the wild ride and sell, sell, sell.
Yep.
But that's a bad, bad, bad idea.
It's a terrible idea because individual investors historically have proven their inability to know when to get out and when to get back in, more importantly. We saw lots of people who got out at the bottom of the 2008 crash and waited too long to get in, so they missed half the recovery. And it's a terrible idea. If you're saving for retirement, you just keep plowing that money in. And times like this, you think, hey, I'm getting a bargain. I'm getting in at a 10% cheaper price, and it averages over time.
All right.
Discipline.
We're going to have you back here over the coming weeks. We're going to talk more about this, and I wish we had more time.
Good to see
you. Get in touch with Chris Hopkins at Barnett and Company. They are right here on Broad Street. The website, barnettandcompany.com. Stick around. More of Let's Chat next.